This week on WealthTrack, legendary great investor Martin Whitman pulls no punches when attacking Congress's ineptitude and Wall Street's ignorance about debt and stocks. In a WealthTrack exclusive, the octogenarian founder of Third Avenue Management delivers a powerful blow for investors. Next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. We are delighted to be taping at the Museum of American Finance, a must-visit destination in the heart of Wall Street. It is the only museum devoted to the history of finance, the foundation of our capitalist system. Be fearful when others are greedy and be greedy when others are fearful is the famous investment maxim of great investor Warren Buffett. We recently learned how phenomenal returns can be when that advice is followed. As the Wall Street Journal reported in its story, Buffett's crisis lending haul reaches $10 billion. Buffett and Berkshire Hathaway tossed financial lifelines to a number of blue chip companies during the financial crisis. From 2008 to 2009, he invested a total of $25.2 billion in 6 companies: candy maker Mars and its Wrigley subsidiary, Goldman Sachs, Bank of America, General Electric, Dow Chemical, and reinsurance giant Swiss Re. According to the Wall Street Journal, Buffett's bonanza, the total dividend and premium return he's gotten so far, is nearly $10 billion, which is about a 40% pre-tax return. Now, Mr. Buffett says an average investor could have done just as well if they bought during the market panic. Well, that is debatable. Few have his resources or ability to obtain terms as favorable. But other great investors were also buying at the lows, including this week's guest. He is legendary deep value investor Martin Whitman. In the throes of the financial crisis 5 years ago, he told us on WealthTrack that investors were in a once-in-a-lifetime opportunity to get very rich. Well, he and his shareholders at the Third Avenue Funds have certainly done extremely well over the years by sticking to his mantra to buy safe and cheap. Whitman is the founder and chairman of the Third Avenue Management. Until March of 2012, he was portfolio manager of the flagship Third Avenue Value Fund, which he started in 1990. And during his tenure, the fund outperformed the markets by a wide margin. A longtime professor of securities analysis at his alma mater, Syracuse University, as well as Yale School of Management, Whitman is the author of several books. His most recent is Modern Security Analysis, co-authored with value investor Fernando Diaz, which takes on 2 pillars of Wall Street thought: modern capital theory, the theory that markets are efficient, and Graham and Dodd's classic approach to analyzing stocks. Whitman maintains both were shown to have shortcomings during the financial crisis, including Wall Street's focus on earnings. As part of a special program in front of a live audience for the Museum of American Finance, I asked Whitman what's wrong with earnings.
If you are just a trader and you're dealing in securities of sudden death, like options, warrants, it's perfectly valid. However, if you want to understand the business and the securities they issue, the emphasis on earnings is of no use. It's not what companies do. They're more interested in wealth creation. It's not what do. Modern capital theory is really tremendously wasteful in the broad scheme of things, and tremendously wasteful in terms of most of what goes on Wall Street.
Why is it wasteful? Yeah.
They focus on 2 things: markets and securities prices, and they're in no position at all, and they're absolutely ignorant of analyzing companies and analyzing the securities issued by companies. So that while it may be useful for traders, it's got nothing to do with value investing, control investing, distress investing, credit analysis, or first and second stage venture capital.
So I know one of the shortcomings that you mentioned is, which is short-termism. So what does that mean?
Four things. You look at the immediate prices. If you're just going to study markets,
right,
you're per se going to be short-term because that's what you do with prices.
Right.
Okay. In the conventional approach, they overemphasize four things: earnings, short-term, top-down analysis like the economy rather than really understanding businesses.
Right, the macro, right, which everyone talks about. Yep.
And fourth is it's based on a belief in equilibrium pricing, that the price is efficient and any change in price will just be impacted by new news on the market. They're utterly oblivious to the companies we mentioned in Chapter 6,
right,
which trade as much as an 80% discount from readily ascertainable net asset values and abundantly solvent businesses. so they're oblivious of that. As for Graham and Dodd, it was a pretty good book for its time. The last edition, I think, was 1962 or 1963. Since then, there has been a tremendous explosion in disclosure. I trace it mostly from the Securities Act amendments in 1964. So unlike the Graham and Dodd days,
right,
now it is absolutely feasible to know tremendous amounts about most companies most of the time. It just was not on their radar screen.
That's a great advantage for investors.
I mean, they have problem is one in security now. They knew tiddly squat about credit analysis.
So let's talk about credit analysis. This is what I love about you, Marty Whitman, is that you tell it as you see them. So you think we should be focused on looking at credit worthiness, that is the most important.
For our investments, a company had better be credit worthy. If we're going to invest in it, it'll only be a creditor, normally as a senior creditor. To invest in the common stocks of poorly capitalized companies has been and will continue to be a dangerous game. It's not something we do. Our investment criteria, again, cover four facets.
Right, and I just want to interrupt you for 1 second, because you call it the safe and cheap. Is your approach, but there's one of my favorite acronyms. There's GAAP, which is generally acceptable accounting practices, but you have GADCP, which is growth at dirt cheap prices.
Yeah,
that's your approach.
Okay, there are four elements to getting growth at dirt cheap prices. Three are easy now. Is one, we don't acquire common stocks unless the company has a super strong financial position, which is pretty easy to ascertain from documents. Two, we only buy into those companies when they're selling at very, very substantial discounts.
So 20%?
Usually 30%, 20% or 30% of readily ascertainable net asset value, where readily ascertainable is not rocket science.
Yep.
Pretty like income producing real estate, like investment companies owning marketable securities. Third is we're not going to be involved in common stock investments unless the company involved provides full comprehensive disclosure including audited statements, and is traded on markets where regulations are very, very protective of minority shareholders.
So the regulatory environment is really critical.
Really important, yeah. And it's really good in places like the United States, Canada, England, Hong Kong, Japan. That's the only analytics we bring to it. I'd like these companies to grow at least at 10% per year compounded. Mm-hmm. That overcomes a lot of the shortcomings of the approach I've just mentioned.
When I read in your book, it was net asset value can grow at least 10% annualized after adding back dividends after 3 to 7 years. So is this kind of a total return
It is a total
approach?
return.
It is.
Yeah, it is a total return. One of the problems with the approach is the market's efficient enough so that when you get these huge discounts, there are usually no catalysts. There's not going to be changes in control. There are not going to be massive mergers and acquisitions, so that the way you profit is unlike other companies.
Right. So you know, a lot of your value investor competitors look at companies and they say, we want a catalyst. We want a company to be in trouble.
Many of the best people won't invest in common stocks unless they see a catalyst.
Right.
Understandable. Us, we get pricing that is unbelievable, much better than they do. I mean, how many? If there's a catalyst, how many common stocks are you going to buy at a 50% discount from readily ascertainable net asset value?
You made your your reputation. You were Mr. Distressed Investing, and you were buying distressed debt. And one of your most successful, the early trade that you made was buying Penn Central bonds when it went bankrupt in whatever it was, 1974. So, but now looking at the portfolios in the Third Avenue funds, the vast majority of them are common stocks. So what happened to distressed debt?
Let me tell you a war story. In the early 70s, when I'm in my business for myself, I had 3 kids and no money, but I wanted to do corporate finance. There were 2 areas that no respectable investment banker would touch in those days. One was stockholder litigation and the other was bankruptcy. So I was pretty good at that business, but I woke up to the fact I couldn't charge like Goldman Sachs or Kuhn Loeb in those days, so I better become an investor. And in investing in distress, I invested in what I figured out, hopefully rightfully, the Fulcrum security, the most senior security that was going to participate in the reorganization, thus the Penn Central mortgage bonds.
Right, and that's where you really learned the creditworthiness.
But if a company has an extremely strong financial position, what's the most senior security to participate in the reorganization? Believe it or not, it's called a common stock. So that it's safe and cheap, which we talked about, I think is just a natural outgrowth of what I was doing as a distressed investor.
The last time you and I talked on WealthTrack was in 2008, believe it or not. We were in the throes of the financial crisis, and you said, this is really a once-in-a-lifetime opportunity to get really rich, with certain caveats, if you knew how to do it.
And with true.
So what's your view of the market now? What kind of, how would you describe the opportunities to get rich in today's market?
I think they're super. We have some type of concentration in East Asia.
You sure do.
Yeah, particularly presence in mainland China, and that's the macro assumption that over the next 5 to 7 years, East Asia is more likely to grow than North America or Europe. It's a simple macro decision, but we're getting into these companies that have been growing like weeds, and I'd say discounts anywhere from 30% to 80%.
And let's talk about that a little bit more in detail, because we just talked about how important the regulatory environment is, but you're buying Hong Kong-based companies only
with a big presence in China.
In China, exactly.
Only because I don't want to go into stock markets where the regulators are not very protective of minority shareholders.
Right.
If insofar as I would want to be a control investor, that might be different. But for an outside minority person, I really have a strong need for strongly regulated markets.
And you're also buying real estate holding companies and development companies based in Hong Kong. And so when I look at your top holdings, I mean, it's Wheelock and Company and Henderson Land and Development,
Holdings.
Shun Holdings.
Hang
Lung Group. These are all Chinese.
And Lysun Development, yeah.
So why real estate?
It's very easy to analyze. Like I said, this readily ascertainable net asset value is not rocket science.
So when you're looking at your real estate holdings of these big companies that you've invested in Hong Kong, these real estate development companies, so are they selling at major discounts to what you think their ascertainable net asset value is?
Oh, yeah.
So this is
what they report their net asset, and all of them, we've restricted all of them to companies which have a huge presence in mainland China. I keep saying, if we're wrong about China, it's not going to be for economic reasons. It's going to be because of social unrest, political unrest, violence in the streets, especially out of Western China. It probably going. We live in a probability world. It's probably going to be okay.
Right.
But my problems with China are not economic.
Yeah, they're political.
They're political and social.
Right. For a guy who avoids risk and wants to buy safe
wait a minute.
And cheap.
If I'm buying at a 50, 60% discount, say Wheelock, and suppose I'm wrong about China, I might not lose a lot of money. I might not lose any. Price is very, very important.
Right.
In safe and cheap.
So the other thing about looking at your portfolios at Third Avenue now is that they're heavily skewed not just to East Asia, which they are, but also to overseas holdings as well, as opposed to U.S.
Yeah. Macro, what's going on in the U.S., can you blame me, Consul? In light of the last 16 days.
Right. As a matter of fact, I asked you before October 17th, when the next financial crisis was going to come, and you told me it could come next Thursday, which was October 17th. We dodged that bullet, but how do you feel?
I don't know that we have. The politicians basically have it wrong. In that, particularly right-wing Republicans. In the economic sense. In the history of this republic and any credit-worthy entity, you better mark down that debt in the aggregate is almost never repaid. It is refinanced and expanded by businesses and governments and even individuals who become creditworthy and increase their creditworthiness. Very important. So all this business about a debt limit,
and the debt limit
is going to end up in chaos, because the truth is the United States federal government is eminently creditworthy. And if it's going to get in trouble, it's that the use of proceeds from borrowing are not wisely spent, not that we're incurring debt. As a matter of fact, to go to the corporate level, I looked at, in Chapter 6, I put down a list of recommended stocks.
Right, in Modern Security Analysis, your book.
Mm-hmm. We went in them in 2007, 2008, and it's obviously every company on the list had much more borrowing capacity in 2013 than they had in 2008. And it's just true in any analysis.
Let me, I'm sure individual investors come up to you all the time. You teach at Yale, you teach at Syracuse University.
Yeah.
How do I make money in the market?
There are a lot of ways to make money. What's
the best way to make money in the market?
Safe and cheap.
Safe and cheap.
But safe and cheap has certain shortcomings. One, you can't do it with borrowed money. Very hard.
Yeah.
You can't afford margin calls.
So don't use leverage.
Don't use leverage, and buy into well-financed companies at huge discounts. Let me again talk about what's wrong with well-financed, which is all I do and a way to make money, but you have to understand a lot of well-financed companies are run by deadhead managements. You want to try to avoid that. And the management of all these companies we're in quite willingly sacrificed return on investment and return on equity in 2013 for the safety inherent in a strong financial position, and also the opportunism it gives them. But in terms of you're going to legitimately measure ROA and ROE, our guys have lower returns than others, though they have lower PE ratios.
Right.
I mean, we're buying these things, say, at 50% discounts.
Such as?
Wheelock. Henderson.
Again, Hong Kong-based real estate development companies.
Maybe Brookfield Asset Management's probably 30% discount.
Right, Canadian-based.
But largely U.S. presence. U.S., Brazil, Canada, Australia. But you have to realize that the Dow Jones average is selling 3 times book. You're buying at 60% a book, and the market itself is 300 times book.
That's pretty stunning.
Yeah, and our price-earnings ratios are equally low.
Right.
I mean, some of the stuff we're buying is less than 2 times earnings.
We always ask our guests at the end of every Wealth Track, what's the one investment we should all own some of in a long-term diversified portfolio? And I think you mentioned that it might be Brookfield, is that right?
Yeah, it would be Brookfield.
And why? What is it about Brookfield that's...
Well, as compared with East Asia, Brookfield, I know the culture, I'm intimate with the people, and we do much together. While I can't say the same about Hong Kong and China, though it's not that bad. One of the things about Hong Kong, all of these companies are controlled by billionaires. And one of the things Hong Kong billionaires insist on doing is come to New York. We send someone over to Hong Kong once a month, but these companies keep visiting us, so you get a good sense. But I can't get the same comfort that I get with Brookfield and Bruce Flatt and all my friends over there.
All right, Marty, we'll leave it there. Thank you so much for being with us.
Thanks for having me.
On Wealth Track at the Museum of American Finance. We really appreciate your being here.
Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is think safe and cheap with your investments. Those are Marty Whitman's simplest golden rules of investing. Safe means a company has the financial wherewithal to weather storms such as the recent financial crisis, and cheap means you pay less for the company than it's worth. As a deep value investor, Whitman looks for stocks or bonds that are selling at 30% discounts or more to what he thinks they are worth. But it's the combination of the two that makes a good investment. Well, next week we are going to sit down with a 5-star fund manager who also focuses on quality and price. The Yachman Fund's Don Yachman will tell us why he is becoming more conservative with his portfolios. And if you wish to see this week's interview with Martin Whitman again and hear where he is putting some of his personal wealth, go to our website and check out our extra feature. And also feel free to connect with us on Facebook and Twitter. In the meantime, have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter.